Welcome to After Hours at TradersPost for March 14th, 2025. I'm Tom Hartman, Hand of the King, joined by Mike, the professional Christensen, to talk all things markets. After Hours is your go-to market commentary show powered by TradersPost, the best automated trading platform in the universe. But we'll tell you about that later. For now, let's talk about the biggest stories moving markets this week. Morgan Stanley sees Tesla as a screaming buy. Gold miners start catching a gold fever bid, and recession talk abounds even as equities catch a bounce. The bell has rung, so let's dive in because as traders, we don't just watch the news, we trade it. How's it going, Mike?
Doing well. It's been an eventful week.
Yeah, and I'm surprised that Trump features only minimally on the outskirts, on the edges of the news that I'm seeing this week, which is pretty fun. What I thought it might be fun to start with is the Tesla, the roller coaster ride that Tesla is on.
Yeah.
Yeah, Morgan Stanley just threw this thing out there that's like, hey, we know that Tesla's down 50%, peak to trough, but we still think that it can be 800 by the end of the year. Let me just pull that up here for 1 second because I thought it was fascinating. I
The
did not
the
see this coming.
the end of a year or within a year?
Within 12 months.
Okay.
Yeah. So the Morgan Stanley note here says Tesla below election price 200, then 800. Tesla shares have fallen 50% from December 17th highs, down 45% year to date, and went down even more after that, on poor sales data, negative brand sentiment, and market degrossing. We see the pullback as a buying opportunity for an embodied AI compounder. I've been hearing this a lot from Kathy Woods, from other analysts out there, that the AI component of basically all of Tesla's holdings, all of Elon Musk's holdings, but especially Tesla, is
hmm
something that can't be accurately measured. The note goes on to talk about the idea that they make the claim that the narrative around Tesla follows the market price. That it's the tail wagging the dog situation over here, and that you can't actually read into that, and that Elon has shown himself in the Doge role that he's perfectly willing to cut what needs to be cut in order to get uh, increase the bottom line, increase net revenue, and that the volatility in the asset, the 50% drawdown, is proof that there's enough volatility here to make it worthwhile and possible for an upside move.
hmm
So I thought it was pretty fascinating. Uh, Is it convincing to you at all to
A-
take a
a-
stab at Tesla?
absolutely. Yeah. I think I'm a little bit different of a position now, but that there again, I love huge drawdowns. They're usually the most attractive times for me to get in on potentially undervalued assets. Interestingly, I still don't see Tesla as undervalued. Using the traditional metric of price to earnings, they're still over 100 PE. But it's one of those things where it's a highly coveted growth stock that, when looked at as a combination of being an automaker and a technology company, and sort of like the future brand involved in the entire emergence of the EV industry. I think there's a few things that I would want to consider in terms of potential headwinds for Tesla. One of it is just the emergence and sort of expansion of electric vehicles across all kinds of different brands. There's a lot of competition out there now that didn't exist even in 2020 when Tesla's price to earnings ratio was over 800. And I think there was a lot of excitement around the brand at that point. And we've since seen some pretty big drawdowns in Tesla's price over that period of time, only to see it rebound when Tesla hits the news again. So this feels a little bit like, I think the narrative that they might be spelling out there is that there is a bit of market voting in place here in terms of Tesla's brand. And a lot of people, I think, are overly invested in the Tesla brand rather than the actual economics of the company. So I am interested in it at this point because it has pulled back so far. Even another 10% would be pretty interesting. If it pulled back to a 60% drawdown would really be interesting to me, because I do think that at some point the news is overblown and there's a pretty good opportunity to find support. So I would probably overlay some technicals on top of this, look for some areas where there's clearly some buyers starting to step back in, and be interested in holding for a period of time to take a decent trade on this. What I do also find interesting is that as I look at some of the the Wall Street analyst feedback on where the street expects Tesla to be in the next year, they're in agreement, maybe not an $800 price target, but across 42 analysts, there's about a sort of an average 1-year price target of $343 at the moment, which even there, that's up 42% over the next year. And there's really a lot of low disagreement between these analysts. That said, what's also interesting is that if you look at where analysts expect Tesla's price to be, even in the next quarter, they're expecting it to be below 200 as well.
So the thing that I find the most fascinating about a Tesla play is that, well, one, years ago, the argument was that they wouldn't even be able to sell any cars. Like there was a whole conspiracy that it was fake and that was just a money laundering operation, or that it was like a intel thing from the government. Like that was the conversation. Then they started shipping out cars. People really liked it, and then it became like the darling for a while in the news cycle. Um, but the idea that that's floating around now, that people are selling the stock because they don't like what he's doing within the administration,
Right.
that I find to be very hard to believe, because big money players don't necessarily, from what I understand, they don't make their decisions based on their feels, the vibe of a thing. It's just about the sale. So there was news floating around this week that BYD, the Chinese counterpart, was actually selling more EVs, but then it came out later on that they're actually including within that the hybrid cars, whereas the Teslas are only selling a pure EV plays.
Mm-hmm.
So I thought that was pretty interesting. But the most fascinating thing to me is the AI component. So Grok, I mean, I don't know how much Grok has taken over, how much share that takes up inside of your AI plays, but to me, Grok has been the best AI tool. I mean, one of the best I've seen ever. And to me, it makes ChatGPT feel like Yahoo to directories to Google. I really feel like I'm missing a huge amount of information. I mean, do you remember the days of for ChatGPT? That data is not within my trading set. I only have information up until
Oh, right. Yeah,
2023.
yeah, yeah. Which is starting
Yeah.
to change now that they can crawl the web. Right.
So yeah, so they can call the reb, and then you're like, okay, so this should have up to date information, but because
Mm-hmm.
it doesn't have social information,
Yeah.
Reddit or
Grok is
Twitter,
impressive from that regard. Yeah. In that perspective, you're absolutely correct.
I feel like, oh, I do the exact same searches on both, and I go, this is a problem, and so
But
I was
I
actually
guess
gonna.
you're seeing Tesla as sort of a proxy to your vote for Twitter's success, though, with Grok or X's success, and I think
Yeah.
that that component where people are basically voting for Elon's endeavors by way of Tesla is part of what unfortunately sort of over amplifies the value of Tesla, because we don't get to play a part in the economics of X or in SpaceX. Well, it's they're neither of those are publicly traded, so we're kind of placing a vote for Elon through Tesla.
But the bet was, we've heard about AI at Tesla back when ChatGPT first started, like when it first took
True.
the world by storm. Elon was sort of shrugging his shoulders, going, "Well, I have an AI at Tesla,
I see
and
what
it's
you mean.
just as good."
So you're saying
Um,
Grok is sort of a preview for how good this technology could be at Tesla.
how fast he developed it,
Hmm.
how great it works, and how useful it is. It's sort of like, well, if this is underpinning, like he was saying that they're using AI in order to get their stuff done, just not in the Chat GPT way, just in
Right.
other ways.
Right.
And so if they're using that in order to solve problems, it actually lends to the whole idea that, hey, we would be 10x more productive with AI on the market. And if he's had this 10 years beforehand, then all the things that Elon's been doing to me seems far more reasonable, as opposed to how on earth is he finding time to actually do all these different projects. And
Okay.
so I'm very fascinated with that. And so and then the reason he had developed the AI, from what I understand, remember, I didn't pull up the clip, but it was for the self-driving, that they needed the AI systems in order to be able to do that properly.
Hmm.
And now they're saying, hey, we're going to have full self-driving, wheelless, like steering wheelless, pedalless vehicles by the end of the year. Have you seen this?
No.
Let me pull this up here.
Yeah.
This is
Let's
the
see
clip
this.
that. 1 second. I mean, Frank, this is Elon and Trump on the
Self-driving. We have so
White House. You let me know if you can hear this.
He makes one car.
Yes.
This one I don't understand. This one I don't want, but that's okay. Without a steering wheel, it comes out next year, right?
Yes.
Explain that, please.
Yes. Well, the Cybercab starts production in Texas next year, and it's self-driving. We have so much confidence in the self-driving nature of it that it'll actually not have a steering wheel. It will not have pedals. It'll either self-drive or not drive at all, but it'll self-drive.
President Trump. And I'm going to pass on that particular. He makes one.
So
Okay,
Trump
so-
doesn't trust
This
it.
one I don't understand.
He's going to pass on the self-driving angle.
He's too old. He's part of the too old generation to risk his life on that.
Okay.
So he was talking about the idea that the AI was used primarily to develop that technology, from what I understand. And so, from what we've seen, they always have more in the tank. There's more, always more in development than what we're actually getting access to. And so, I have no doubt, like his conviction for how good self-driving is, to me, I believe it. And then you get these stories of people, what is it, they're using Waymo in California,
Mhm.
and some people are just swearing by it, saying that this makes Uber feel like what Uber felt like to taxis. And I can't believe we're even having that conversation so soon. And so this has been one of the reasons why Kathy Wood at ARK Invest has been saying that this will be a game changer and generate revenues the likes of which we're not modeling right now for the Tesla company, just based on car sales or battery sales. So but then the real question is that, okay, so what's the play, right? Sure, you can just be long Tesla, totally. But if you want to do the degen route, you can do calls on Tesla. And I just wanted to pull this up because I always love to see what the option play is. And the idea here is that, let's say that Tesla does rise to $800 by next March. If that's the case, if you buy the highest call you can get is 630. I don't think you can get any higher than that. Yeah, 630 for March, which would cost you $965 for the call. But if it pays out, it can pay out between 12 and 16x. If it gets there, like at the latest possible time next March. Obviously, if it gets there earlier, you can make 20 times the money on the premium. I find when I see a chart like this, then I go, I sort of just want to. I sort of just want to take the trade, because why not? I'll put money like that on Polymarket. I might as well do it on options.
Sure. I think one way to help offset the risk of that a little bit would be to consider a call debit spread. That way, at least you're profiting from the sell side of that as well. And that gives you a little bit of protection on that end. But if you're extremely confident in the long-term success of AI being integrated into self-driving, then you probably would look at something like a long combo or a risk reversal, where you're essentially buying the call option but selling a put option to pay for the cost of those premiums at the same time.
That's right. Well, the call spreads I've always never loved because I hate capping my profits. Because you only
True, but that's how you reduce some of that risk, right? And you're not completely exposed, other than the cost of the premium.
Yeah, but I always prefer to cover my risk by having a smaller position, not by capping profits.
Got it.
Otherwise, I feel like, well, why am I taking this trade? Or there's other trades I don't have to swing for the fences like this. I could just make 10% on something else just regularly.
Yeah.
That's how I feel. But
so you see this approach as more of the lottery ticket. Then, if it plays out, then you make a handsome reward. If it doesn't, you just pay the cost of the premiums.
Yeah. Plus, if you want to pitch this to a family member, pitch this to a friend, start talking to them about call spreads, like, they're going to roll their eyes and they won't hear anything about it. But they go, look, just press this button and buy a call inside your broker's account. Okay, I'll give that a shot.
Gotcha. Okay.
Then not only do you get the 20x profit, you also get to look like a hero to your family and friends, which I'm saying feels even better than anything else.
It's promising. I definitely agree overall with the sentiment that the news is probably overhyped to the bottom line here. I think it's important to, typically try to pay attention to what's actually happening to fundamentals for a company before you make any big calls. The news does a very good job of making things sound worse than they really are. With the rumors around people like rebranding their Teslas or putting Mazda or Audi symbols in the place of the Tesla logo.
People are doing that?
Absolutely. There's pictures of it on Twitter as well. I don't know if
I
you've
see.
seen this, but it is a little comedic because it says a lot about the potential for brand equity erosion that's occurring at Tesla, but how large scale has that really become is the bigger question. And I'm not sure that that's large enough to be a huge issue. So I definitely am in the camp of really wanting to keep an eye on Tesla now that it's pulled back so far.
Right. You get hardware for you get software, you get political wins, you get meme stock craziness.
The
The Tesla
downside
stock
is
is
it does
really
not come without volatility. It is a shaky stock. So
that's right.
you can get in and still see another 20% downside even from getting in at this point.
Eek.
I think that's the danger you play. So sure, you could take a smaller position size, or you can hedge some of that risk out by trying to do some kind of a vertical spread.
You said you were looking. You might be looking at like you would be looking at entries 10% down from today's closing price, or from the lows that we had a little while
I
ago.
might have actually missed it, to be honest. I think the better support zone would have been at about 220, which, obviously
Okay.
I tend to not buy in at those zones because I need confirmation first. We're starting to get closer to what I would consider confirmation before getting in. So unfortunately, I'm going to miss those bottoms at 220 unless it pulls back and pulls back even further from here. I would expect that the next support zone, which is like closer to this 63% drawdown or 65% drawdown, is closer to a price target of 178.
And just to mention, like it retraced, but it was these two gap fills over here.
Yeah, these gaps
Right.
those are the upside gaps, right? And so you're right. We filled both of those gaps now. But looking at the long-term picture, even from a fib retracement perspective, I think there's still room to pull back even further. We kind of touched that 0618 level at the 220. But I would expect if there's going to be one more pullback here that we would pull back to the 786 level, which is at that 180 mark.
Okay, perfect. That would actually coincide with what I'm feeling. I feel until we get past options expiry here, March 20th, I'm not really looking for any solid foundation. Like one more liquidation down and then up, and we'll see.
Good play.
All right. Next, are gold miners about to explode higher? Gold prices have surged, but mining stocks have lagged behind a bit until now. Is this finally the moment when miners catch up in a massive way? Mike, you sent me down this gold miners rabbit hole, which is pretty funny for me because when I started trading, I was trading gold miners. That's like what I spent my whole time doing, and I'm looking at SA reports and exploration companies and junior miners versus everything.
Mhm.
And I was really fascinated with it until I started trading bonds, and then I was like, well, I don't need to trade gold anymore. Bonds are I don't have to worry about some junior miner what they're doing. I just buy the U.S. Treasury and deal with that.
Sure.
But still, it's a fascinating thing because gold has ripped, right? Gold is is it at 3,000? Did it even break 3,000 yet?
Yeah, where is gold now? So
Almost 29.91.
closed at
Yeah, it hit a
29.82. So
high.
almost there. Nice little push yesterday. Almost crossed the psychological barrier there at 3,000.
Yeah. I mean, it didn't close. There was a high of 3,017 on the futures contract. I
Oh,
don't know
really?
what's up.
Okay. So a
Yeah.
little bit of divergence there, but yeah, I have been paying attention to a few companies that have started to receive a lot of trading volume. Sorry, let me correct my screen here. It looks like it's a little off. Let me stop sharing and try to reshare again. Share window. There we go. And there were a few companies that actually popped out in terms of overall volume that started to appear on the charts. There's a company called Orla Mining, which has received a ton of attention lately from traders. New Gold Incorporated, and another company called Equinox Gold Corp. These three companies started to appear on a screener of mine because they're also undervalued companies from a fundamental perspective. But as we kind of look at the comparison of them all in the last year, Just looking at the last 1 year chart relative to the S&P 500, these gold stocks are soaring. NGD is up 89%, Orla's up 136%, while gold's up 37% and EQX is up 35%. S&P is only up 9% over that same period of time. Even year to date, all of these current positions are looking pretty impressive, with Orla up 48% since the start of the year.
So what I've been loving about, Mike, your analysis of stocks now over the last couple of months I've been paying attention to, is that, I mean, you keep finding these meme plays, like these GameStop level moves in these charts.
Sure.
Like, it was ever since crypto, I sort of like stopped thinking about stocks moving 100%, 200%, 300% or more. I just
Right.
put that away, and turns out, no, you've proven to me they are everywhere. And more so, is it more so now that the indexes are like value is outperforming in some locations? Like, sorry, it's a stock pickers market, basically, that you can actually find things and have a thesis played out and actually make 300% on a move.
I think that's true, especially with sort of the rotation that we started to see as large cap stocks reached an all-time high. People were a little concerned that that part of the market, or that sector in terms of market cap, was a little frothy. There was some sector rotation into mid caps and small caps, and these companies are starting to see some action. And usually when you start to see volume flow in these smaller cap companies, they can move really fast because there's less liquidity, and there's a lot more excitement from a retail perspective, and it can pick up really, really fast. So yeah, to your point, there are definitely like sort of meme crypto style plays here that can move very quickly in less than a year, or even in this case, less than I guess a little more than 3 months. With Orla up 48%, that's definitely crypto style moves here.
Well, I was all my go-to people that I used to listen to all the time before, Shifts, Katsuna. I couldn't find a bunch of these people to get an idea of what's going on, get the rundown. But there was this one guy, Garrett Goggins, who I thought had a great interview at Kiko Mining, giving a good breakdown on a few things that are actually affecting the gold price and on how to choose a gold miners to invest in. So I just want to play let's play a couple of clips on that, and then I'll get your thoughts. All right. So we're going to start off here with the idea here of the difference between investing in gold and GDX. So there has been like this discrepancy in the charts. Actually, let me just pull that up real quick so we can see it before we start, where the performance hasn't been as exciting for the mining sector as it has for gold. So let's say we just use GLD. Let's say. What we're seeing here at the top is GLD. Let's say at the bottom we put GDX. We're seeing that GLD broke above the previous high, and we haven't even done that on the miners ETF or VanEck. Same thing with GDXJ, the junior miners. We haven't retraced the highs, and then even on some of the big names like Barrick Gold. No, not that one. Barrick Gold. Also, we get this downtrend. So a lot of people have been like, "Hey, why is my Newmont mine and why is my Barrick Gold not going up? Why are these things not skyrocketing?" Gold's basically at 3,000. That's the bet that people wanted to play, and Garrett Goggins does a great job, I find, in explaining some of these details. So let me just pull that up.
You get the new electric back.
Now, do you think?
You know what? It's really wild because a lot of people show the charts of the GDX, gold being up here, GDX being down here. They're like, all right, there's the opportunity, right? Like the jaws are going to close. Like, that's a myth. Like, the GDX is never going to catch up to gold. Why? Because you're comparing apples and oranges. You're comparing gold, which is the world's best independent asset that's a store value for 1,000 years, that has no expenses, it's unencumbered, versus a stock, right? GDX is made up of the gold stocks. The only thing that drives gold stocks is increasing free cash flow on a per share basis. And you get a mining company, the miners have all sorts of expenses, right? You got to pay your miners, you got to pay the management, you have options, you got G&A. there's a lot of expenses. So, I believe we're set up to have a good rally in the GDX right here, but you need to find the miners that can drive free cash flow on a per share basis, because that's what the stock price follows. And I follow this very closely. I follow the big 5 miners on a free cash flow to share price since 2015. The average miner is 25%, average large cap miner is 25% undervalued versus free cash flow per share since 2015. This is the biggest opportunity since 2020, and before that 2015. GDX took off and ramped higher, 100% higher over the next few months. And Newmont's earnings today just like proved it out, because the discount could be explained away by if they came out with bad earnings, rising costs, and therefore they're not making as much free cash. But Newmont did the opposite, right? They lowered their all-in sustaining costs to around $14.50, and they're
5% year on year. Yeah,
and they increased production. Like, they're generating $1.6 billion a quarter. That's based off fourth quarter gold price. Never mind the 2,900 gold price we're in now. That's like $7 billion. That's a ton of money. That is free cash flow. That's how to drive the share price. Free cash flow is used to pay dividends, buy back shares, and do smart things to, do creative things to drive shareholder value.
So that's like, to me, it feels like that old school way of thinking about stocks, like free cash flow, efficient companies, cut the pork, get good management, and you're like, okay, yeah, if they have that with an asset that with a base material that's going up in price, as long as they keep going down, that free cash flow keeps increasing. And then later on in the interview, he talks about the idea of, then if you smartly use that in order to buy back shares, in order to give dividends, it becomes more attractive for investors to come to the market. And so you get this lag from the price to directly to the miners that are actually more effective.
Right. I think it also kind of highlights a potential error that one can make when observing some of these individual holdings as a potential pairs trade. This is a good one to observe if you're measuring sort of the co-integration between the two to determine whether or not these are actually converging and diverging in a way that makes this an appropriate mean reversion play, right? Like,
between
his
GDX
point
and gold.
And gold, yeah.
Okay.
Let's say the other side of your trade, you were holding a gold ETF or a gold futures contract. Trying to profit between those divergences isn't really effective, because to his point, you're comparing apples to oranges. So, of course, if you were doing this very quantitatively, you'd probably already see that there's really not a high co-integration between those two symbols, and you probably wouldn't trade it anyway. But I think it's an important distinction to make between what you're actually buying when you buy into the gold industry.
That's right. All right, so let's see what he has to say here. I thought his comments here on the price of gold and the effect that the price of gold has on these miners was interesting.
Now, you mentioned royalty companies, royalty and streaming companies. They've outperformed gold companies for a number of years. As with the kind of market we're in now, gold at $2,900 per ounce, are gold companies now in a position to sort of fight back and...
Yeah, the royalties outperform when the market isn't doing great. When we're in a strong uptrend like here, the gold miners do well. But the royalties do well, right? Because they have fixed costs. When inflation pushes gold higher, it pushes costs higher as well, and that's what the miners struggle with constantly. I'd like to say that a lot of people, I'm out there on Twitter pretty often. There's a lot of people on Twitter that recommend low-grade moose pastures, right? They're like, listen, when the price of gold goes to 5,000, this stock is going to go up 50x. It's like, no, it's not, because when the gold price is 5,000, the costs are going to be 5x, 6x higher, and the project is still going to be economic at 5,000 versus 3,000. So you need.
So the idea here is that if inflation is the thing that's causing the gold price to go up, then there's a bunch of input costs that also rise for the miners as well, and you have to factor that in as well. And so it could be that a poorly managed or poorly run miner is just as unprofitable at $5,000 gold as they are at $3,000 gold, which I think is a pretty fascinating. Which is why you can look at a gold stock and it's tanked. You're like, how is this tanked? Gold at 3,000? How's it in the toilet? It's because you have to be efficient. My portfolio has a bunch of these gold miners that are just like not performing at all.
I think there are similar reasons that airline stocks as well as oil stocks are difficult to determine the long-term upside for similar exploration and mining costs that can change on a variable basis. So yeah, I think that's a fair observation here. I was kind of interested there in the moment in your outline about their take on the Fort Knox audit. I know we covered that a couple of episodes ago. Was there anything of interest there?
Absolutely, yeah. So he talks about. I thought it was interesting because I thought it was gonna be like the conspiracy land, but it's not. It's very practical what he says here. So let's see.
Well, I like practicality.
Elon Musk.
Right.
Elon Musk wants to audit the Treasury and audit the gold that's held at Fort Knox. And this is really gathering steam. Besant just talked that down yesterday, saying, hey, we did an audit last year, all the gold's there yet. But the thing is, the gold might be there, but it's loaned out. That's what bankers do. A bank's got cash. What do they do with the cash? Do they let it sit there? No, they loan it out once, twice, 10 times, 100 times, right? So that gold is there. It's just loaned out many times over. So they need to track that paper trail. And when they track that paper trail, they're going to find out who's been short millions of gold ounces, and those guys are going to have to buy it back. That's what I think the tariffs are driving gold back to the United States. But I think the U.S. is reclaiming their gold. So all that whole paper trail, they're going to have to buy back their gold. That's what's been driving the gold price higher.
And another,
I find that to be
another
so fascinating.
I do too. It's another exogenous factor that seems to be driving gold prices up. In addition to what we covered on what's happening in Europe right now a couple weeks ago, that's another upcoming factor then that's worth considering.
Yeah, because when because what I had found so fascinating about gold years ago is that it was correlated very strongly with interest rates and the dollar, and so and you would have this inverse correlation between the dollar and rates and gold, except in periods where it is there's economic uncertainty about the financial system, in which gold could go up as well. But then the price that we were seeing on gold recently over the last year or so seemed to move beyond the economic uncertainty, because it started decoupling from like how interest rates were moving, long-term interest rates were moving. It's like, wait, interest rates are the lower interest rates go, so the more money you can get on the bond, the less gold is attractive, because the bond is actually generating a yield. And so the idea is that if interest rates go lower, then gold can go up. But gold was going up whether interest rates were going up or down. And then it was also going up whether or not the dollar was going up and down. I was like, what is going on? The dollar's going up or down, interest rates are, so that means some other factor is pushing the price. And he suggests here that it's because the holders who are short gold, because you're short gold for a number of reasons,
are going to have to buy back to cover.
They know they're going to have a squeeze, that they're going to be squeezed out of it, and that this is a front run to that squeeze, or positions being cleared out, and that they know that, and what supports that is that idea of that the gold is moving from London to New York. That some of that movement has to do with it.
For sure, and the shortage and the disparity in prices between those two markets. Tom, how closely are you following the options market around gold?
Not at all anymore.
Interesting. Okay, I'd be curious your thoughts on that if we do this in another upcoming episode.
Okay, I'll take a look at that. Yeah, you know what? I would do options on the futures contract, but I wonder even on the
ETFs.
Yeah, because I did a lot of options on options plays on the miners. Terrible idea. Terrible, terrible. No matter, the wins do not pay for the losses. It makes no sense to do that. My God.
Maybe it would have been better to be on the other side of that, selling premium rather than buying.
I just find it so difficult to sell options.
I see.
I can't sleep. If you're covered, that's one thing, but or hedged in some way. But I was never able to. I never found that as interesting. Whereas if you buy options on currency futures, that's like, it's like almost feels like free money sometimes when it's going your way. I never worry about anything.
Right.
All right. The last thing I wanted to show from this guy's interview is his prediction for what could happen with gold over the next year or so.
At tons, and it's not going away, it's increasing.
So it sounds like we're in the early innings of something that's going to go much bigger. So how do you think the rest of the year is going to play out? What are you telling your readers?
To be honest with you, I'm a fundamental analyst. I'm a CFA, MBA from Boston. I value things based off free cash flow per basis. I'm gold. I like to be gold agnostic. I look at the gold price as being the cherry on top of the big ice cream sundae. You need to find miners that have independent value drivers. If you're investing in a mining company solely because you believe the price of gold is going higher, you're going to lose money. There's a lot of things. I follow the trough of the Lassonde curve, right? The first trough is exploration. Company Sanu Gold at Dyna just released 50 meters of 3.1 grams a ton. It's got the Lundins back in them. It's got Montage Gold back in them. And it's in a great gold district. That stock has ripped up higher. And once you discover a deposit with one good drill hole, it takes years to build it out, right? Like you got no ounces or reserves. So they keep drilling, finding more. The stock price keeps going higher. And then they reach a stage where they have a mineralization report, and then they need financing, and the stock price usually trades down then. So the second trough of the Lassonde curve is when they're at the trough, they go through financing, and you get NAV, right, which is the total value of profits from a mine versus market cap. And there's a spread. Market cap is low, NAV is high. On first production, market cap should value NAV because miners are worth the most on day one of production, and then as they mine, the reserves go down. So there's tremendous opportunities I see in the market, and we don't need a higher gold price. Montage Gold trades for $300 million. And Kone is worth $2 billion at $2,900 gold. Rio 2, Alex Black did it before with Rio Alto. He's doing it now in Phoenix, in Chile, and that stock's trading at like 200 mil. It's worth $1 billion, and that's off 20,000 tons per day. A base case feasibility study, that thing ramps up to 80,000 tons per day. There's another one, Longcore Gold. They own a Dumby, and it's in the DRC. Yes, it's risky, but Mark Bristow with Barrick has been operating there successfully at Kibali for 15 years with no issues. Longcore Gold trades at like 40 million market cap, and a Dumby's worth $1 billion. That's like 30x upside. Just the value represented in the sector. So as they build out.
So I mean, this I
Super
just love this
fascinating.
passion about it. There's all kinds of different plays within the market there, and so like you already mentioned, Orla was up like 135% over the
In the
last
last
year. AEM up 86%. Sanu that he's talking about up 500%. Montage Gold 116%. Sanu's on Canadian Stock Exchange, I believe.
Yeah. And so is Montage.
Yeah, so some of these moves are just, I mean, crypto people wish that's what's happening with meme stocks right now.
Sure.
You really want to get back into it. The last thing I wanted to say on that was right. So, but GLD, if you wanted to just play the gold play and you didn't want to deal with the miners or anything like that, GLD is mapping basically one for one to the gold price. And there's an argument to be made that it's such an effective ETF that it's actually draining money away from the GDX and GDXJ as people want to easily express their bullishness for gold. All right. Before we jump into our final segment, let's take a moment to shout out TradersPost, the automated trading platform designed to take the friction out of executing your strategies. Whether you're trading stocks, futures, or crypto, TradersPost connects seamlessly to your broker or exchange, giving you the flexibility to automate your trades without missing a beat. If you're tired of being the bottleneck in your own success, it's time to let automation do the heavy lifting. Head over to TradersPost.io and see how easy it is to streamline your trading. TradersPost, because your strategy deserves to run at full speed. All right, last story, Recession Watch. Oh my God, recession. This doom porn that happens everywhere. So finally, Recession Watch is on. The official numbers don't say recession yet, but leading indicators might tell a different story. Is the slowdown real or just a scare?
As a reminder, it feels like more often than not, many of the macro experts out there predict about 20 to 25 of the last 3 recessions. So let's just remember that this comes up quite a bit. If you've heard this story over and over and over again in your trading career, it's easy. It should be easy to take this stuff with a grain of salt. However, what have we discovered so far, Tom?
Yeah, well, just to mention what we were talking about in previous episodes is that a recession is different than a market correction, folks. Okay, the stock market could go down 15%. It doesn't mean a recession has started. It just means
Agreed.
it's a pullback in liquidity or pullback in investor
And there's
sentiment
lots
or
of
whatnot.
reasons for a pullback, not necessarily a decline in GDP.
Exactly. And so in our Carson corners we've been talking about, he's been calling out these periods of weaknesses that happen around options expiry, and
Mhm.
he made the claim that between February 20th and March 20th there's an air pocket and we might fall. Hey, that's exactly what happened.
Mhm.
And when we take a look at what's the market position, and we're seeing that now vol is actually getting pretty well supplied. The volatility surface of the indexes has smoothed out, and so the chance for another 10% down, not so high right now without a catalyst. So vol is being supplied there. It doesn't mean that a recession can't happen, but as far as this forward-looking market behavior, that's not what we're seeing right now. It seems to be a liquidity issue. However, it would behoove us to actually take a look at some of the criteria here that we would be watching for if a recession was going to happen, right? So I know everyone always talks about the technical recession, 2 quarters of negative GDP, which I find to be the worst possible definition for a recession. To me, Mike, it's like when people describe inflation as rising prices.
Mhm.
I I want to blow my brain out. I can't believe they keep saying that. Yes, if you look online, because of like colloquially people have used that again and again. Yes, the dictionary has changed the term for inflation to mean rise in prices, but that's not what inflation is. Inflation is inflating the money supply,
Mhm.
increasing the money supply that's in circulation, which has the effect of causing high prices.
Which reduces
Uh,
your purchasing power automatically,
ex-
right? It's like,
exactly.
it's probably easier to think about it by saying what you used to be able to buy for $1, you can no longer buy for $1, right? It's
That's
not
right.
just about the general increase in prices, but rather the erosion of your purchasing power over time.
Correct. Which is different, let's say, than currency debasement, which is what when the Fed buys bonds or buys public assets or monetizes debt, that has a different effect, which is like asset price increases and real estate goes up or whatever. But that's not inflation specifically.
Sure, sure.
Well, similarly, recessions, folks, recessions are contraction periods to the expansion periods of fiscal largesse. That's what it is. It's when the economy is juiced. The economy goes through these ebbs and flows where more and more people enter into the starting new businesses, get new jobs or whatever, and then you have this dynamic between employment and consumer spending that causes this expansionary period that can go on forever. It needs to pull back at some point, and you're going to get a contractionary period exacerbated by how central banks print money or do whatever they're doing, or government spending. And so recessions are natural. The thing is, to call 2 quarters of negative GDP a technical recession is like calling a 10% drop in the stock market a bear market.
Sure. I think that's a correct assessment. And I think right now the news is basically more concerned that we're seeing additional GDP contraction, but not necessarily a negative GDP growth. If we can go back to like Q1 of 2022 and Q2 of 2022, we experienced 2 quarters of negative GDP growth during those periods, but we didn't count that as an actual recession. Since then, we've seen an increase in GDP growth over 22 and 23, but we've seen a contraction in that GDP growth quarter over quarter. All of that said, it's still not in negative territory yet. I think right now the St. Louis Fed is predicting that there will be another contraction in GDP growth, but we're still in positive territory. We're not even in negative territory yet. Additionally, if I were to add to that definition, I would say we would also need to see that negative GDP growth accompanied with a larger increase in unemployment. We've been varying around these unemployment rates of like the changes have been 0.1 or maybe
4.3,
0.3,
4.1,
like very small differences in overall unemployment change. We're still at what, 4.2 right now, or 4.3?
4.3, yeah.
4.3. 4.3 or 4.1. The point is, it's still at 4%. We're at basically 96% full employment in America. So I would want to see that coupled with larger layoffs than some of the headline numbers that we're seeing. about, the 80,000 people fired from X company or let go from one company or from another, and so on and so forth. I know there's been some headline news around layoffs, but they're not big enough to make a large enough impact across the entire private sector. We're not seeing enough of that reported to show that unemployment is increasing by, a concerning degree. I think that would be my second stance on.
Yeah, I just want to make the point here that the three other major institutions that declare recessions, their their definitions for recessions are super vague. So, for example, the NBER, the National Bureau of Economic Research, they are looking for a decline in GDP, real income, employment, industrial production, and wholesale and retail sales. The IMF, International Monetary Fund, they're looking for a general decline in economic activity. That's literally what they have in their documentation. General
So
decline.
it's feelings based. That's what I'm hearing.
Feelings based is vibes based, exactly. And the OECD, they're looking for a cumulative output gap of for the GDP of more than 2%. So they're looking for this cumulative effect over time. None of them will have a set, like you can't make an indicator specifically for GDPs happening, and
Sure.
you can only really look at it in retrospect. And so there's actually no point in sitting around calling the recession. Like it doesn't make any sense because you can only really know it in the rearview mirror. What really matters is the decisions you'll make if a recession so this is always the point I want to make. We know a recession is going to come. Like people act like we can avoid the recession. It's a bad thing that we need to avoid. No, it's going to come, and you have to then plan accordingly. The grasshopper and the ant idea over here. And so to that end, I still do look at recessionary indicators to give me some sense of the mile markers of what direction we're actually moving in.
Agreed.
If we take a look at, I thought it might be nice to, hey, I'll pull up Grok. Grok did a great job of this. Deep research. 1 second here.
And no, this is not a paid sponsorship from Elon Musk or Tesla.
It could be.
Or
if they want to sponsor us, I'll take it.
If they want to reach out and let us know. Right now, we're filling our ad spot with our own company.
So we already talked about GDP growth rate, which is still positive, if just a little bit slow. Unemployment rate. Oh, it's at 4.1. You're right. 4.1, not 4.3 for unemployment rate. So the yield curve hasn't inverted again. Usually you're looking for a yield curve inversion. It's gotten 9 out of the 10 recessions. You need a yield curve inversion. And in fact, not just an inversion, you need it to uninvert for it to start the clock for the recession. You're looking for a stock market performance of a bear market of 20% decline from recent highs. Remember, the stock market is supposed to be forward-looking, and so it should reflect the recessionary forces before it actually hits the main street. And so we're not even we're halfway to 20% drawdown on the stock market. We're looking for decline in industrial production that we haven't gotten either. We have a 0.5 month-over-month increase in December 2024, and the month before that was 0.9%. So a little bit of a slowdown, but not recessionary yet. Retail sales is on the fence because we're looking for consumer spending in order to keep up, the debt-based economy, and then a bunch of other things. Oil prices have gone down. Inflation seems to be if not stable, a little bit falling. Credit conditions is the only thing that I'm if I take a look at this for credit conditions.
Yeah, I know NFCI has been a big one that you followed for a little while.
Absolutely. So we have this tick up that's happening, or this uptick at the end over here. So this could be the start of basically the recession starts when you cross this zero line. But you're looking, and it's always from the bottoms that you get these higher highs and higher lows.
Sure.
But if we're headed towards a recession, we're starting that process. Sure, you might say, Tom, we might get some big catalyst that causes a recession all at once. Fine, but you can't really plan for that.
And I think that's the thing, is I tend to be data driven. I'm sure you are as well. it's so easy to take headline news and extrapolate that into a narrative that makes you think that things are far worse than they actually are. A perfect example of this is the news headlines around how some of the big banks are starting to forecast an increased risk of a recession in the next year. JP Morgan is now estimating a 31% probability, up from 17% in November, and Goldman Sachs, their model is ticked up to 23%. But I think it's important to look at that number the other way around. What JP Morgan is basically saying is that there's a 69% chance that we're not going to see a probability of a recession. So, just because the number has ticked up, to your point with the financial conditions index, we're still well below that zero line territory. It feels like early days here to be making any calls on a recession. What do you think?
Yeah, absolutely. There's only, if there's one thing I'd be concerned about,
Mhm.
it's this. So, well, two things specifically. One, I'll show the yield curve again here, because the yield curve went all wonky because of COVID. And so we have this weird situation. I'm going to pull up my TradingView. This is an indicator I made at the bottom here. You're seeing yield curve for the 2 year.
Mhm.
The blue one is the one we're going to be talking about, which is the 2s10s. And then you're seeing on the chart here, these red areas are where the Fed considers there to have been recessions.
Okay.
And then we're seeing on the chart over here. So just these blue markers over here match these blue markers for when the yield curve inverts. So if we take a look at historically, we'll see that we get
So I
yield curve.
stand corrected on my earlier statement. I guess I had forgotten that the Fed actually did call that small period of time in 22 an actual recession then.
Yeah, that's right.
Okay.
They have a special word for that. I forget what it is specifically. Actually, let me pull it up because I want people to know.
And maybe that's another reminder on this thing too. Even if we get to some magical zone where we've decided, okay, we're definitely in a recession, there's a couple of things to take away from that. And I will sort of jump on the bandwagon of these common phrases that we hear in the markets all the time. One is that we probably will find out we're in a recession after we're already about halfway through it. And the other factor to consider is that most recessions only last about 10 months on average. So the first thing to consider there is that because most of these indicators are lagging indicators, we don't get this data until the end of the quarter. That leaves so much time for us to kind of play a guessing game about what the data is actually going to tell us in the future.
That's right. So just what you mentioned over there, that mini recession in 2022. This is what it was, this blip. So compared to this one is COVID, this one is global financial crisis, this is a dot-com bubble. And so
Right.
even though it's a recession,
Yeah, that little guy down there, I wasn't worried about that little guy. I don't know about you, but we did really well since 22 if you were invested in the markets.
Well, what happened there, like if we take a look at the markets here, we see that we had this pullback, right? I think this was literally 20%. Yeah, 27%. And if you literally bought all the way through here, you did better than anyone who was like waiting and got back in later on,
right?
Because we then went to all-time highs. But what I wanted to point out over here is, so we have yield curve inversion, and then about between a year and 2 years after the yield curve inverts for the 2s10s, you get the recessionary period. Again over here, recessionary period. Again over here, recessionary period. Before COVID too, which is why I was short during COVID, because we had a recessionary signal. I was very happy about that. But I was not happy about this bounce afterwards, but that's a whole other story. This is what worries me. We got this yield curve inversion for the 2s10s, right? And it happened after. So this happened so quickly. This drop happened so quickly that the GDP recession indicator, the yield curve took some time to come into play. So you could find the speed of this is what mattered. But then we stayed. You're not going to see there. We stayed inverted for the longest time we've ever stayed inverted.
Right.
All the way up to about summer of last summer.
Yeah.
Of 2024.
During mind you, if you measure that bull market from the bottom, during a hell of a run there from the bottom.
From here?
Mm-hmm.
Yeah. Yeah, absolutely.
80% run up.
Right. So because I count a recession for the yield curve as the yield curve uninverting, there's a case to be made that we should not count this uninversion over here, that we should count this uninversion over here. In which case, we've set the clock for basically from this summer over the next year, look for the recession. And I've seen a lot of people that I respect in the space, Ken Carson's, Darius Dales, the Mike Greens of the world, who are saying that these sorts of things, that they are anticipating a recession as of the second half of 2025 or beginning of 2026, which I could definitely see happening. If that is the case, though, we should get first a rise to a new high and then a rollover.
And yeah,
Because
I'd want to see, and we've talked about this on the show as well in the past, the market's going to give us our earliest signal. We can't wait too long, unfortunately, for economic data to come through to tell us the real story or not. The market will know in advance. So we're going to be looking for some pretty big pullbacks in markets first.
That's right. I didn't get a chance to pull up the yield curve information for before 1988, but I wanted to just point out this period over here that I have been following, which is the inflationary period from the late 60s to late 70s,
Sure.
where on election years, stock market rose like 20%, but beyond that, we just had barely all-time highs and then pullbacks, and barely all-time highs and pullbacks. So what is this? This is Nixon, Ford, Carter, Bush. And so if we're following that patterns, we have to make sure that as investors and traders that we don't get fooled by these types of drops. These types of drops
not a big enough drop. Right. I'm with you.
Yeah, so we can't be fooled by that. You need to have the corresponding slowdowns inside of the economy, and even if you're worried about inflation over time, as long as you're smart enough in order to avoid these drawdowns, or even go short to take advantage of them, to place yourself accordingly, you could make money through this entire period. The people who don't make this money through this period are ironically the buy and holders. Right, that's the problem, to buy and hold and not take a look at it.
Right.
And so this is one of the reasons why I care so much about markets education. Even if you're not like an active trader every day, knowledge of these systems gives you an edge, and you can end up past these troublesome periods better off than when you first started.
Yeah, I think it's fair to point out too that almost every recession that you had in that red zone there presented a hell of a buying opportunity for investors.
That's a great point.
It's really important to realize that by the time the Fed or any of the Federal Reserves start to say that we're in a recession, we likely have already found the bottom in markets. And once you found the bottom in markets, that's the buying opportunity. Each one of these has one of those opportunities presented in it, where there's a big enough pullback where you can start buying undervalued companies, or ones that some of the favorite brands that you've seen before, Tesla being an interesting example, maybe a little early for the game here, but some of these pullbacks, it's a good opportunity to DCA in my mind, slowly add to these positions as prices are coming down. I think Tom and I, we've talked about how quickly some of these reversals are taking place as well, and how they're accelerating in their pace. COVID being a perfect example of this, where that was probably one of the fastest and deepest pullbacks I've ever seen, that recovered and then accelerated faster than I've ever seen in the past as well. Those recoveries are pretty fascinating, because it just means that I would be watching the markets like a hawk during periods where we might be getting some initial data telling us we're in a recession, and the market is going to find a bottom right in the middle of that before we're even out of the recession.
You're absolutely right. That's a great point to make here, that the recession, people are burned by .com and mortgage crisis,
Correct.
GFC.
Yeah.
They think all market corrections are like, big drops. This is what you're going to experience.
Mm-hmm.
You have to understand that after the mortgage crisis, there was a complete 10-year change of the financial systems, to the point even that banks aren't even the main issuers of credit within, or money within the global dollar system.
Right.
With Basel 1, 2, and 3, it literally changed over this period of time. So you'll see here marked as Basel. Yeah, the Basel 3 started over here, and so we had Eurodollar 1, 2, and 3. And what happened is two things. One, the governments realized that they could do QE, right? QE wasn't a thing before really a thing before the global financial crisis. They have QE to come in and ease financial conditions in order to mitigate downside risk. That's where the Fed put came into play. Then you have passive investment flows. I don't know how much you've taken a look into this, Mike, but this idea here that the
401ks are buying automatically every 2 weeks.
Exactly.
Yep.
That's right. And if they're buying it automatically, they're not forced sellers, right? In fact, they're not forced sellers until unemployment gets high enough. Not at 4.1%. They're not forced sellers. And so if net, and I forget what it was, I think it's 2012 or 2013, something like that, where the amount of passive flows beat past active flows. And you get this thing where not only is the downside mitigated because they're not forced sellers, they don't even know what stocks they're buying. They're not even thinking about it. They're just buying the index. You have this effect where because they're buying the index, any stock that then gets added into the index, like when Tesla got to a high enough market cap and met the requirements, whatever got into the index, then those passive investors are forced buying Tesla. And so you get this reflexive loop to the upside. And then whenever there's this downside risk, the gamma, as people buy options for their cover to the downside for the puts, and then they have calls. Those calls, as soon as you get a certain bounce, might go up 100%, 300%, 500% in value, and then you get this chase up, this chase up in asset prices, which is why we see this skyrocketing. Which is why I no longer look at stock charts or these types of stock charts with regular. I only look at it logarithmically. I don't know if you guys have ever noticed this on the channel. I don't look at it this way.
Yeah,
because it seems crazy this way. But once you look at it logarithmically and you realize, oh, it's a rate of change here that we're dealing with, then it looks completely reasonable.
It's easier to see the patterns when you look at it logarithmically as well.
That's right. So I'm not really worried about recession now. It doesn't mean that we can get new lows or anything like that. But the idea that we're gonna have a 10-year recession after .com, GFC, or whatever, I'm not worried about that yet. Talk to me again in 6 months, and we'll see.
Yeah, I like this comment here from TJ here in the notes, basically saying people are burned from 01 and 01 is now just a blip on the chart. Same with COVID. I completely agree with you across my entire investing career, especially right in college when 01 hit. Moving forward, it was a really long correction period. It took a long time to get back to break even on that part of the chart. But since then, our recoveries have been much more rapid. And I expect that because of the tool the Fed can now use, we will continue to see pretty rapid recoveries, even if there's sharp pullbacks in the market. So to that point, I agree. I think most of these corrections that we see in markets are going to be pretty short-lived blips on the chart, and thinking over long periods of time, 5 or 10 years or more, I think is the right way to think about your returns in the overall.
That's right. The last thing I wanted to mention there is that Scott Bessent, he does talk about, I just wanted to pull this up because I mean, I gotta say, this is my favorite Treasury Secretary I've ever seen. He's been so fun, so candid, and he's also like part robot, clearly. And so it just feels like everything he says comes from this place of honesty. He doesn't know how to lie properly. He's sometimes too honest. So I just wanted to play this one small part here where he's been interviewed on CNBC talking about recessionary signals.
Tax cuts, but just while we're on trade and the response from corporate America, when you say that when we're in a period of detox, you used that word on CNBC last week, is that a euphemism for recession?
Not at all. It doesn't have to be, because it'll depend on how quickly the baton gets handed off. Our goal is to have a smooth transition. But I tell you, Sarah, the easy thing for us to have done would have been to come in and just keep this massive spending level going. And it's unsustainable, but we have kept it going for a year, 2 years, maybe even 4. Maybe, but you're risking a financial calamity. So, we are trying to get this tax bill done. We are controlling expenses. And when we get the tax bill done, so if you can change the trajectory, up revenues, up economic growth, hold expenses flat, or do the unthinkable and cut expenses, then that's a pretty good trajectory on growth. And, if we go back to the model in the 90s,
all right. So, and then he goes on to say that if there was a company that you heard that was cutting drastically spending, cutting labor drastically, and trying to increase productivity, you would be buying that company hand over fist. And he goes, and that's what we're trying to do over here. So there's all kinds of complaints I have with how they're going about that and what the actual outcomes might be or what have you. But this type of talk is what I wanted to hear during the global financial crisis with the Ron Paul revolution, the whole thing. That's what I wanted. Fiscal conservatism, but without it bleeding over into the social sphere. Just get the spending under control and get productivity up. And and they understand that there's a period of adjustment for that, the detox that might be a downturn in the markets. But take that for what it is.
Well, as usual, volatility usually means opportunity. So I hope you guys are out there taking as many of those positive plays as you can.
That's right. All right, I gotta go buy Tesla. I gotta go buy Tesla now. All right, thank you guys. We'll be back next Friday with more After Hours.
Cheers, everyone.